Well, hello, hello. We're back here again for another quick update with Josh. Josh, how was your week?
It's been going fantastic. We're getting lots of interesting news coming through and looking forward to sharing that with you.
Yeah, we've seen some really interesting data this week on inflation and the numbers and how they're reporting. Like, what can you tell us about that?
So, what I can tell you is actually last week when the inflation data came in for the month of October, it actually came in lower than expected. And a big part of the reason is energy costs have come down. So, we had like 3.8% inflation was the number for September. They expected around 3.4, and it came down all the way down to 3.2%. So, again, really close to the Bank of Canada's range of 1% to 3%. I have a chart here just showing kind of what's been normal over the last 10 years. And if you take a look at it, it's kind of ignoring the inflation peak after COVID happened, of course. A lot of that was kind of between 1% and 2%, actually. And the few times that inflation went above the 2% mark is actually correlates with times that we saw interest rates increase. So with it coming down, that's a positive thing as we're considering what's going to be happening with interest rates.
So I guess maybe for the bear share of our clients, like because we have a ton of them, right, that are going to be renewing soon. I'm guessing it looks like the market's got a big sort of renewal coming up. Like, what does this mean for them?
Actually, I put together a blog post earlier today, and in that blog post, I quoted a well-known or renowned economist named David Rosenberg. Yeah, he had an article or an interview that he had with Bloomberg, and they were talking actually about exactly that. A lot of mortgage renewals are coming up in Canada, and with people who kind of right now, I guess we're looking at 2018 mortgages because most people take that 5-year term. People in 2018 would have been locking in the mid 3% range. And so if they're renewing now around 5.5 or so percent, they are, experiencing some definite increase in payments as a result. 2024, so next year, that would be then 2019 mortgages renewing. We're going to see about an increase in monthly payment of probably around 15% if rates remain similar to where they are today. But then if we get into 2025, which would then be 2020 renewals, rates had dropped. Other than briefly when COVID first started, rates were low in 2020. So we would be seeing more like a 30% increase in the payments for anybody who started their term back in 2020. And the big one actually is in 2026. That's when rates in 2021, we saw 5-year fixed rates between 1.5% and 2% for quite a while, actually. So those people will be seeing, assuming rates don't change, a 45% increase to their mortgage payments, which is just astronomical. So he's actually calling for the Bank of Canada to push toward lowering their rates by 2% over the next year or so. And in doing so, we would see not only, of course, variable rate mortgages lowering, but along with that, we would see the fixed rate mortgages also decreasing. With the expectation is that there won't be any more increases. And then April next year, in the spring sometime, is when most of the economists that were recently polled by Reuters, they're saying that in around April is when we're going to start seeing the first of the interest rate decreases happening. So we can cross our fingers that that's the case, and then kind of go with that.
Yeah, so really, that's good news. If you're a seller, right? Like, let's get ready for the spring market. I think I'd be a little bit cautious if you're just a buyer. So you again want to take caution about how long you wait to buy. Not financial advice, of course, but kind of want to buy before everybody else does.
Yeah, and that's maybe, I think we kind of talked about maybe doing that video today, but I think maybe next week would make sense that we can talk about what it would look like buying at today's prices with today's interest rates, and maybe choosing a little bit shorter term compared to waiting for interest rates to drop, say 1%, but then how much more of an increase in home prices would that compare to?
Quickly, just one last question here, and then we'll get going back to work here. But so I've had this question from a lot of clients, and they said, like, if I have a mortgage for 5 years and I go to renew, should the amount that I'm mortgaging lower, and so will that offset a bit of what was happening when you get this interest shock, or is like what happens with the principal that their rates are based on?
For a standard renewal, what happens is, let's say 5 years ago, you started with a 25-year amortization at 3.5% or something like that. Now we're at a 20-year remaining amortization. So if we do see the payment or the interest rate increase, it will have an impact. But because it is a shorter amortization and there's a smaller balance owing, as you owe less and less money, the actual dollar impact of an increase in mortgage payment becomes less and less.
Right.
So while it's not perfect, it's not a solution to everything. It does become less and less as you have fewer years remaining on your mortgage, and as a bigger portion of your payment skews toward being principal repayment instead of the interest on the loan itself.
Right. So hence the term you said about stretching your amortization note if you have enough, equity in your home to kind of ease a shock if we need to go there. But that's another video for another day. Thanks for joining us here.
That can shave quite a lot for sure.
Yeah. So there's obviously these tactics. So yeah, seller or buyer, reach out. Need a new mortgage, of course, you know who to call. Thanks for joining me, Josh. Look forward to talking to you again next week.
Thanks so much, Jay. Bye-bye.